Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business. What it does, how it makes money, and what makes it competitively distinct.
XPO in its modern form was created in 2011 when Brad Jacobs acquired a small freight brokerage called Express One and began assembling what would become one of North America's largest transportation companies through a rapid acquisition strategy.
The defining product type here is less than truckload freight, or LTL. Unlike full truckload shipping where one customer fills an entire truck, LTL consolidates shipments from multiple customers into a single truck, sharing the cost of transport.
That consolidation model requires a dense network of service centers, facilities where freight is collected, sorted, and dispatched across the country. XPO operates over 870 of these service centers in North America alone.
The 2015 acquisition of Conway Freight for $3 billion was the pivotal move that made XPO a genuine LTL major, adding an established network and tens of thousands of existing customer relationships at once.
In 2021, XPO spun off its contract logistics division as a separate company called GXO Logistics. That separation transformed XPO into a pure-play LTL and freight transportation business. The sharper identity management believed the market would value more highly.
The primary financial metric in the LTL industry is the operating ratio, operating expenses as a percentage of revenue. A lower ratio is better.
Revenue per hundredweight is the other key metric. It measures how much XPO earns for every 100 pounds of freight it moves. Consistent annual improvement in this yield metric reflects successful freight mix management and pricing discipline.
The competitive landscape in North American LTL is led by Old Dominion Freight Line, the acknowledged best-in-class operator, followed by Saia and TFI International.
XPO Connect is the company's proprietary digital platform, giving shippers real-time freight visibility, automated rate quotes, and booking tools. Technology differentiation in freight is increasingly important as customers demand more data transparency.
The European transportation segment adds geographic diversification, operating in over 15 countries. This business operates on different economics than LTL, more regional trucking, providing a different demand profile than the North American freight cycle.
Mario Harik became CEO in 2023. He had served as XPO's Chief Information Officer for over a decade before transitioning to run the North American LTL business, a background that positions him uniquely to drive the technology-led operational improvement agenda.
Free cash flow margins are growing toward 8% as the operating ratio improves and capital requirements stabilize. XPO does not pay a regular dividend, preferring to direct available cash toward debt reduction and network investments.
The network density advantage in LTL is difficult to overstate.
Building 870-plus service centers with the real estate, equipment, and trained driver workforce takes years of sustained investment, a barrier that makes meaningful new LTL entry essentially impossible.
That's the company chapter for XPO. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
XPO reported Q1 2026 adjusted EPS of $1.01, beating the 88-cent estimate by nearly 15%. Revenue came in at $2.1 billion, up 7.3% year over year. The stock fell 2.4% post-earnings despite the beat as investors focused on freight market softness and the fact that shares already trade above the average analyst price target.
XPO is one of the largest less-than-truckload freight carriers in North America. LTL shipping consolidates freight from multiple shippers into a single truck, a network density business where scale and route efficiency are everything. XPO operates roughly 900 terminals across the U.S. and Europe, making it the second-largest LTL carrier by shipment volume behind Old Dominion Freight Line.
The company has been executing a focused turnaround since spinning off its brokerage business. At a $25.8 billion market cap, XPO trades at 48.7 times forward earnings, a valuation that prices in successful execution of its operating ratio improvement plan. No dividend is paid. All capital is directed toward reducing the operating ratio and servicing $3.8 billion in net debt.
Q1 2026 adjusted EPS of $1.01 beat the 88-cent estimate by 14.8%, the strongest beat in 3 quarters. GAAP EPS of 85 cents reflects amortization of intangibles and transaction costs. Revenue of $2.1 billion grew 7.3% year-over-year, beating the $2.06 billion consensus estimate.
The operating ratio, the key performance metric in LTL freight, improved to approximately 90.3% in Q1 from around 92% a year ago. In LTL, a lower operating ratio means more profit per shipment. XPO's long-term target is an operating ratio below 83% by 2027, which would put it in range with best-in-class peers. Each percentage point of OR improvement on an $8 billion revenue run rate translates to roughly $80 million in additional operating income.
Shipment volume growth was in the low to mid-single digits, reflecting cautious freight demand in an environment of soft industrial production. Revenue per shipment improved, driven by disciplined yield management and a favorable mix shift toward higher weight shipments. The Yellow Corporation bankruptcy in mid-2023 transferred over 900 customers to XPO and meaningfully boosted market share in key corridors.
European logistics contributed modestly, with that segment growing at a slower pace than North American LTL. XPO Smart, the company's proprietary routing and load planning technology, drove measurable dock and line haul cost savings. Management attributed 1 full point of operating ratio improvement to XPO Smart efficiencies implemented in the last 12 months.
Free cash flow on a trailing 12-month basis was $457 million. Cash on hand was $237 million against net debt of $3.79 billion, a leverage ratio of approximately 4.4 times EBITDA. The balance sheet limits buybacks, but management has guided toward debt paydown as the primary use of excess free cash flow.
Full year 2026 consensus revenue estimate is $8.57 billion, implying continued mid-single-digit growth. Full-year EPS consensus of $4.52 implies significant acceleration from Q1's annualized run rate. Management did not revise guidance but signaled confidence that freight pricing and volume trends would normalize in the back half of the year as the industrial economy stabilizes.
Analyst consensus heading into Q1 was 21 buy ratings, 9 holds, and 1 sell, a heavily bullish setup. The average price target of $203 sits below the current stock price of $220, meaning the median analyst on the street thinks XPO is overvalued at today's levels. That is an unusual situation, a stock trading above consensus target with mostly buy ratings.
The bull case from banks like Morgan Stanley centers on operating ratio improvement as a durable multi-year earnings driver. The argument, XPO's OR is still above 90, while Old Dominion runs in the low 70s. Closing even half of that gap over 3 years would produce EPS north of $7, making the current 49 times forward multiple look expensive today, but reasonable on a 2028 basis.
More cautious analysts point to the valuation disconnect. At $220 per share against a $203 target, XPO already prices in full execution of the OR improvement plan with limited margin for error. If freight volumes remain soft through mid-2026 and pricing power weakens, the OR improvement stalls, and a 49 times multiple on slower growth earnings is difficult to defend.
Peer context matters here. Old Dominion trades at approximately 27 times forward earnings, with an operating ratio in the low 70s. Saia trades at similar multiples. XPO's premium to these mature peers reflects the turnaround optionality. Investors are paying for the journey from 90 to 83, not the destination.
The consensus takeaway, the Q1 beat, confirmed the turnaround thesis is intact, but the stock above analyst target means near-term upside is priced in. Watch operating ratio each quarter. Any stall in improvement will compress the multiple rapidly given the high valuation. The Yellow Corporation customer retention cohort is the key swing variable to watch through 2026.
The bull case is straightforward. XPO has the most operating ratio improvement potential of any major LTL carrier. Running at 90 plus versus Old Dominion in the low 70s, the gap is enormous. If XPO can reach 83% OR by 2027 as guided, EPS would approach $7, a multiple of the current consensus of $4.52. The yellow bankruptcy gave XPO 900 customers and incremental density to accelerate that improvement.
XPO Smart Technology is a legitimate differentiator. Proprietary AI-driven load optimization and dock scheduling reduce labor hours per shipment and improve trailer utilization. Management credits XPO Smart with 1 full OR percentage point of annual improvement, and the technology roadmap targets additional automation at the terminal level through 2027. If the technology delivers ahead of schedule, the OR trajectory accelerates faster than the market currently models.
The bear case starts with the stock price. At 220 against a 203 analyst target, the consensus view is that XPO is already overvalued. The market is pricing in full OR improvement execution in an environment where freight volumes remain soft. If the industrial economy slows further, LTL volumes decline, and OR improvement stalls because the cost structure is semi-fixed while revenue drops.
Net debt of $3.79 billion is the financial risk. At approximately 4 times EBITDA, XPO's leverage limits financial flexibility. If a freight recession hits and EBITDA compresses, the leverage ratio rises and debt refinancing risk increases. Unlike Old Dominion, which holds net cash, XPO cannot lean on its balance sheet during a downturn.
OR improvement is not linear. XPO went from approximately 95% to 90% over 2 years, a meaningful improvement. Going from 90 to 83 is the harder part, requiring structural terminal network upgrades, driver productivity improvements, and consistent freight pricing above inflation. Each incremental OR point becomes more operationally complex than the last.
Europe is a wild card. The European logistics segment operates in a different regulatory and labor environment. Any macro slowdown in European industrial activity disproportionately hits XPO's international segment, adding earnings volatility that North American investors may not fully model.
Old Dominion Freight Line is the gold standard. ODFL trades at approximately 27 times forward earnings with an operating ratio in the low 70s and essentially no net debt. ODFL's margins reflect decades of network density investment. XPO at 49 times forward earnings is pricing in full execution of a multi-year OR improvement journey that ODFL completed years ago.
Saia Inc. is the growth at scale peer. Saia has been rapidly expanding its terminal network in markets where it was historically underrepresented, taking market share from Yellow's collapse similar to XPO. Saia trades at approximately 25 times forward earnings with a mid-80s operating ratio, more expensive on a price-to-OR improvement potential basis than XPO, but with cleaner execution history.
FedEx Freight and ABF Freight, owned by ArcBest, represent the broader LTL competitive set. FedEx Freight is being spun off, creating a publicly traded comp that will provide cleaner LTL valuation benchmarks. ABF trades at discounted multiples reflecting weaker OR performance. XPO's 49 times multiple is the highest in LTL, justified only by the turnaround premium.
Across all LTL peers, the key metric is operating ratio, not EPS. Investors who believe XPO reaches an 83% OR by 2027 see compelling value. Investors who model a plateau near 88 see a richly valued turnaround with high leverage and a stock already above analyst targets.
Pre-earnings options positioning was cautious, reflecting the stock's premium to analyst targets. The put-call ratio settled near 1.1, slightly elevated, indicating hedging activity. The options market implied a 4 to 5% move around earnings. The actual 2.4% decline on a 14.8% EPS beat reflects the market's view that the beat was priced in.
Post-earnings options activity showed defensive positioning. Put buyers targeted the $200 and $210 strikes for June, consistent with investors protecting gains at current elevated levels. Call activity was muted, suggesting institutional holders are not aggressively adding exposure above the analyst target zone. Implied volatility compressed after earnings, reflecting reduced near-term uncertainty about the turnaround trajectory.
Insider activity is not a signal at XPO. CEO Mario Herrick has participated in standard equity compensation vesting without notable open market purchases. No insider has made a significant open market buy at current prices, which is notable given the elevated valuation. Insiders are not signaling that the stock is cheap at $220.
Institutional positioning reflects a split consensus. Large active managers with freight expertise hold overweight positions, betting on the OR improvement thesis. Passive index ownership has increased as XPO gained weight in mid-cap growth indices. Short interest is moderate at approximately 5% of float, not extreme, but above the LTL sector average, reflecting some skepticism about the premium valuation.
XPO delivered 14.8% adjusted EPS beat, 7.3% revenue growth, and continued operating ratio improvement toward the 83% target. Yellow Corporation's bankruptcy provided 900 incremental customers and meaningful density gains.
Risks are real. Stock trades above analyst targets, freight volumes remain soft, net debt is high, and OR improvement gets harder each step. At 49 times forward earnings, execution must be flawless. Watch operating ratio every quarter, the only metric that drives this thesis. Financial data and charts sourced from Financial Modeling Prep. Charged alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.